So this is Texas Joe. He's been kind enough to join the Plumber Stacker, and we're going to be talking about some investing. We're talking about stacking silver versus collecting silver. He's going to give you a little bit of his background just to let you know that he kind of knows what he's talking about. So go ahead, Joe.
Yeah. So my name is Joe. I'm 56 years old, live in Texas. I've been investing since the late 80s, early 90s. And originally from New York City, and I moved to Austin. Went to school there and stayed behind. Worked for a couple PC companies and went out and formed my own company after a while in real estate. Was wildly successful with it. It's a family business.
What type of real estate?
Residential brokerage. Did that. That's kind of how I made my bones. And I self-direct my own investment portfolio. Made a lot of mistakes, but also have a lot of successes too. And gained a lot of knowledge over the years. Learning, how to properly invest capital and do it prudently.
So as far as directing your own investments, so I've looked into it and I've read and watched some videos on. I'm more of a visual person than a reader, but I do try to read, especially when it interests me. So I've read across a few just billionaires, and they say that diversity isn't really the way to go unless you're lazy. So, I mean, not those exact words, but they say, if you own 50 stocks, how could you possibly know about all of them? But if you own a handful of them, and you know them in and out, right, you're more apt to make a larger return on your money. So,
yeah, let me speak to what you said. You have to realize that most of these hedge fund billionaires, they maintain like their own staffing to kind of do all the research for them. Mm-hmm. And, they have a philosophy of, if you believe in diversity, it's basically because you don't know what you're doing and you just kind of spread your risk out amongst all of it. And partly that's true. They've been known as the smart money as long as I could remember. I think that's changed. I think retail investing and the empowerment that was started about, I'd say 20 years ago with allowing people to kind of self-direct has changed a lot of that. Keep in mind that that's being tendered from guys who have their own kind of due diligence staff that kind of look into to find opportunities, and then they pounce in there, like they can do it, because they got the press on their side. They have their folks on CNBC and Fox Business that'll interview them whenever they want, and they can kind of they have a lot of political sway. Politicians maybe that that they've contributed to.
One or two.
So, partly that's part right, but for the individual investor, that's absolutely the wrong way to go. So I have a very classical approach. I try to save all the money I can while I can. So right now I'm retired, but when I was younger and I was making a lot of money, I would put quite a bit back. Mm-hmm. And I would, put that in 401ks and SEPs and Roths. Not so much individual accounts because they don't offer you any tax incentives to do so. So I would focus on saving. And then two, I kind of surrounded myself with information. I'm an information junkie. I love information. I love diverse opinions. I want to hear a bull case and I want to hear a bear case. I'm not a perma bull. I'm not a perma bear. but I like both because I want to hear their arguments. My classical approach is, I invest in stocks, bonds, commodities like silver. But my commodity exposure is more broad-based, across the whole spectrum of commodities, and then the all-important cash, what we call margin of safety. So 80% of that is vested, has an asset allocation that is appropriate for my risk. Right, I'm kind of on in years, and I'll take some risk, but I have a moderate approach. So I have a lot of bonds, and then the stocks I have are going to be mostly like ETFs, mutual funds. Not as much as they used to be on mutual funds, but ETFs. And then a small amount of my portfolio, say 20% of it, is individual stocks.
A couple things I wanted to touch on there. One, again, neither Joe nor I are financial advisors. Joe's just giving you his life experience, and he's been quite successful at it. So I figured that he'd be a great person to bring on and talk to us about diversifying, what he does, how he got successful and how he remains successful, and how he keeps his money through the markets. Obviously, he's been in the ups and downs just like all of us have. So a couple of questions that do come up quite a bit, especially in the age of cryptocurrency, is taxes. How do you, and again, we're not accountants either. You could take our information or leave it. This is just all informative for you out there. So, so say you made 50 grand on Bitcoin, you pull it out. What do you do with it? How do you avoid paying that initial whack on capital gains?
Well, you don't, and you may not have. You may be. So, in order for you to be taxable at capital gain, you have to have held it for a certain amount of time. Otherwise, it's just taxed like regular income. Almost all of my holdings, except for a cash portion, which is in an individual account, is in retirement accounts. So I can basically buy and sell, reap gains, and pay no taxes because it's all deferred till I actually start withdrawing from the account, and then I pay normal, income taxes like everyone else. So how do you avoid, if you're in an individual account trading Bitcoin, there's no way to avoid that tax burden. Once you take that profit, you owe the money.
Mm-hmm. So even like, I know there's a misconception as well, is all right, so if I cashed out my Bitcoin, but it still sat in that platform, right. I didn't take it out, does that count as you're going to get taxed on that regardless because you cashed out that stock or that crypto?
That's right. It's Robinhood, Coinbase, they're going to report your transaction.
Okay.
So whether you take the money out of that, out of their, platform doesn't matter. It's the type of account that matters. So.
And that goes same for stocks, right? Stocks in general.
In an individual account, yes. In 401ks, SEP accounts, IRAs, Roth IRAs, which are handled a little bit differently, no. You don't. The tax is not due, and you're allowed to reinvest those, or let it just sit there as cash.
Are there funds like that where you can kind of manage your own, like 401ks or Roth? Like, are you able to buy and sell what you want, or do you have to follow along what?
Yeah. So if you're a 401k, it means that you're tied to a company that sponsors, your retirement plan. So let's use. Say Verizon, for instance. Verizon, they'll allow you to self-direct 50%. So you can take that 50%, put it in a brokerage link account that's tied to your 401k. Then, separate from that, you have your retirement plan with Verizon that's vested in the funds and whatever they've set up already. Most of it's ETFs now. S&P based, mid cap based, foreign, and then bonds, and then stable funds, stable income funds. So 50% of what you contribute will go there. 50% will go into your self-directed, and then some companies may allow 100%, but I don't know of any.
And you say self-directed, that means you can buy and sell stocks at your will.
That's right. Leisure. I buy what I want, when I want. I sell when I want, and do whatever I want. I'm directing the whole thing.
And then that's for the 401k. So what about the Roths? Is that what I'm saying that right? Like if you're in, you create your own investment account. So the same type of rules, other than you get to play with all of it.
Right. Yeah. So the rules changed quite a bit on Roth, because you don't have a plan administrator for a company saying, you can't do that. That's against our rules. Now it's just all on you. So on a Roth, say for someone my age, I can contribute up to $6,500 per year of my income into that. That money that's after tax money now. Okay. So I've already paid income tax on anything that goes in a Roth. And then that goes into my Roth, and that grows and compounds tax free. So when I become 57 and a half years old, 58 and a half years old, excuse me, and I want to start drawing on those funds, I can do so without paying any income tax. Now, there's an act of Congress. You listen to a lot of people. They're talking about being able to tax those. They want to go after it. So, but right now, those are the rules.
So even your profit, like if you turn 50 grand into 200 grand, you could take that out.
Tax free, buddy.
It's already been taxed.
That's right.
Before it went in.
That's probably the best deal for someone who's young and their employer doesn't have a 401k. A Roth is where you need to start.
And again, like that's all about doing your homework. When I got into trading maybe a year ago, I do all my own, and it was, I got whacked. I seriously got whacked. And it was because I thought that I could just jump in, follow a few people, and hey, they're making money, so I'm going to make money. But they're pulling triggers that you don't know about, for one, and they're getting out well before they tell you. They're getting out by and so on and so forth. And then you're stuck making your own decisions. So if you don't know what you're investing in, you'll wind up like that. And I did lose quite a bit of money. I mean, luckily, I informed myself, and not, like you said, you love knowledge, you love information. And that's exactly what I did. And I turned everything around and actually wound up making a lot of money, not a lot of money, but I made, a decent chunk. But I could have made a lot more if I would have went into it educated, talking to somebody like yourself or a financial advisor before you do it, because you can talk to financial advisors before you start your own investment account. So I would suggest to anybody, do your homework, man, because you will get hit.
Yeah, well, do your homework. Always work with like a fiduciary. That term's kind of used quite a bit lately. A fiduciary is somebody who charges you a percentage, but they act in your best interest. If you're dealing with somebody who's not a fiduciary, they could work you into these financial instruments that really aren't appropriate for you. And then if you want to get out of them, you're paying these huge penalties to get out. But, they get paid large commissions and things like that.
Thanks for watching the Plumber Stacker, where I show you my stack, but not my crack. Please like, share, and subscribe.